making money in trading is the favorite for everyone. But there is a take to it. You need to know the pattern, you need to know the trend, and along with that, you need to know candles, candlestick patterns, what they suggest. So these are bullish candles, which is giving the impulse to the upside with corrective side. So if you are not familiar with the candle, this is the open of that day, I'm quoting daily, and then this is the close. So sellers were able to push it till this point, but again buyers came back in and pushed it all the way up here. Then some profit takers, short term, those guys moved out and it closed here. The following day, it opened day and went up and closed. Yeah, they had the volatility day, but you still managed to go to the upside. So that's the trend. Now, what we're going to discuss today is bullish patterns and bearish patterns, both. But for these patterns to be valid, they need to happen on a support or a resistance zone. What do I mean by that? See, when you are looking at the price, say the price goes high, it consolidates some range, it come back down. So this is happening to be a support here. You get the point? So the price had some reaction. That means, what this actually means is sellers or buyers in the market, they had some exchange back in time at that price. So next time when the price comes to that range, you most likely will have another exchange. So that's your support resistance zone. So now when the price goes back up, fine. And when it is correcting lower, this is where you are anticipating that it may make a double bottom and then reverse. So that's one of the hard path, right? So now we take this into the candlestick. So now you know what the support and resistance is, and what we're going to look at is different patterns. Now let's look at the bullish one first. So if you are looking for a red candle and say the trend was bearish, you were coming down these following days, and then you're going to look at like, okay, there's a reversal. What's that reversal like? This is a red candle, it closed to the downside, so the next candle happens to open here. And if it happened to close above this one, so this is that neckline which it crossed and went above. So the entire movement here was erased by the buyers. So this is an engulfing candle, right? Now this one you can get intermediately, it doesn't actually matter. If that happens to be on a long-term support resistance zone, now that's valid and you're getting a bullish signal. That means it's going to go to the upside. Now imagine you're going to get the same, you were actually going to the downside, you were getting all this stuff, and you can be also giving a doji. Say the price is still here, it's closed in green, but you have a wick to the upside and a long wick to the downside, which means the sellers, they continue to sell into the market, the supply was increased, but buyers were able to push that back up. All those supply which was dropped into the market was absorbed by the buyers. So now there is a huge possibility that this is a buying zone. If the price come back here, the history is going to repeat. So chances are high that next one is going to be like this. So these are just simple patterns. Now when you combine all of these three candles there, you get bullish momentum. Now you're looking for this particular pattern and we call it kind of a hammer, right? You got that hammer here, that's an inverted hammer, and you go that side. So when it happens at the bottom of a correction or somewhere, after 4, 5, 6 candles of red, and then you get this, most likely that's going to be a correction. Now a lot of different candlestick patterns, we're going to look through all of them one by one. But if you liked this short segment, hit those like button, and if you want to look at another one, look here and follow that.